stock markets can experience rapid and substantial declines in value. These declines can occur within a short time frame, such as a few hours. Market stability is not always guaranteed, despite appearances. The rationality and predictability of markets can be challenged by unexpected events. The mid-1980 seconds witnessed a significant boom in the stock market. This period was characterized by widespread optimism and rapidly increasing asset values. The rapid increase in asset values set the stage for a subsequent market correction. Underlying vulnerabilities were present, masked by the apparent prosperity. The archival footage highlights the exuberance and financial growth of the era. Portfolio insurance strategies were developed and promoted by key financial figures. These figures introduced novel theories of risk management. Their strategies aimed to protect portfolios against market downturns. Institutional investors widely adopted these portfolio insurance techniques. The adoption was driven by the promise of downside protection. However, the widespread use of these strategies had unintended consequences. Program trading involves computerized systems executing trades automatically. These systems operate based on preset algorithms. Program trading has led to an increase in market activity due to its speed. The scale of operations in program trading is significantly larger than manual trading. Computerized systems have increased their influence on financial markets. Market overvaluation occurs when asset prices exceed their intrinsic economic value. Price-to-earnings ratios are rising, signaling potential instability. Analysts are expressing growing unease about the market's inflated values. Economic indicators suggest a divergence between market prices and underlying fundamentals. A weakening US dollar can trigger investor anxiety due to its potential impact on asset values. A large US trade deficit indicates that the country is importing more goods and services than it exports. This trade imbalance can put downward pressure on the dollar's value. Investors may become concerned about the long-term sustainability of the US economy. Global economic imbalances highlight the interconnectedness of international markets. These factors collectively contribute to investor uncertainty and potential shifts in capital flows. The Friday before Black Monday was marked by the release of disappointing trade figures. These figures triggered an initial sell-off in the market. The market's sell-off reflected growing investor concerns about the bull market's sustainability. Uncertainty began to permeate the investment community. A sense of panic started to develop among investors. These events collectively set the stage for the subsequent market crash. The scene recreates the New York Stock Exchange on the 19th of October 1987. The time is set at the opening bell on that Monday. Sound effects are used to build a sense of mounting chaos. Visual cues further intensify the feeling of a market sell-off. The overall atmosphere conveys the intensity of Black Monday. Program trading can intensify market declines through automated processes. Automated sell orders trigger further sell orders. This creates a self-reinforcing feedback loop. The feedback loop accelerates the rate at which prices decline. This exacerbates market instability. Portfolio insurance strategies aimed to protect investors from market downturns. These strategies involve dynamically adjusting portfolio asset allocations. The goal was to reduce equity exposure as markets declined. However, these strategies often relied on selling assets during market declines. This coordinated selling pressure exacerbated market downturns. The resulting flood of sell orders contributed to the failure of portfolio insurance. A liquidity crisis arises when there is an overwhelming surge of sell orders. Market makers, responsible for maintaining orderly markets, become unable to absorb the high volume of sales. Overwhelmed, market makers reduce their participation or completely retreat from the market. This retreat disrupts the market's normal functioning, leading to a breakdown in liquidity. Panic selling occurs when investors sell their holdings due to fear of further price declines. Individual investors are particularly vulnerable to panic selling during market crashes. Sudden and dramatic market declines often catch individual investors off guard. This leads to a sense of fear and desperation as investors try to minimize losses. Many investors attempt to sell their holdings rapidly, exacerbating the market downturn. Government officials initially responded to the crisis with attempts to reassure investors. Market regulators also implemented measures aimed at stabilizing the rapidly declining market. These initial efforts proved largely ineffective in stopping the widespread selling. The market's downward trend continued despite the attempted interventions. The Federal Reserve, led by Alan Greenspan, intervened to supply liquidity to the financial system. This intervention aimed to prevent a complete collapse of the financial system. The Fed's actions were crucial in stabilizing the markets during a period of crisis. Providing liquidity helped to restore confidence and prevent further economic damage. The stock market demonstrates resilience in the aftermath of Black Monday. Recovery is observed over the weeks and months following the crash. The market gradually regains its value after the initial shock. Investor confidence slowly returns as stability increases. Trading volumes begin to normalize, indicating renewed participation. The recovery period showcases the market's ability to bounce back from severe downturns. Following the market crash, regulatory changes were implemented to enhance market stability. These changes included the introduction of circuit breakers. Circuit breakers are designed to temporarily halt trading during periods of significant market decline. Other mechanisms were also introduced to prevent similar events from recurring. The reforms aim to safeguard against excessive volatility and improve overall market resilience. Black Monday significantly altered investor behavior and market strategies. The crash heightened investor awareness regarding market risks and volatility. Post-Black Monday, investors placed a greater emphasis on portfolio diversification. These changes reflected a shift towards more cautious and risk-aware investment approaches. The scene draws parallels between Black Monday and the dot-com bubble. It highlights recurring patterns of market exuberance. The scene also emphasizes the eventual market correction. Both events demonstrate cycles of investment and subsequent downturn. This scene draws parallels between the conditions leading to Black Monday and the 2008 financial crisis. The focus is on highlighting the systemic risks that can accumulate within the financial system. Both events demonstrate how interconnectedness can amplify vulnerabilities. These crises underscore the importance of regulatory oversight and risk management. Understanding these parallels can inform strategies to prevent future financial instability. Historical data reveals recurring patterns in market crashes. These patterns highlight the cyclical nature of financial crises. Analysis of past crashes shows similarities in causes and effects. Understanding these patterns is crucial for predicting future crises. Learning from past mistakes can help mitigate the severity of future market crashes. Investors must acknowledge the inherent risks in financial markets. It's crucial not to assume perpetual market growth. Thoroughly research investments before committing capital. Avoid relying exclusively on external advice. Conduct independent analysis. Diversification is a critical strategy for effective risk management in investment portfolios. It involves spreading investments across various asset classes to mitigate potential losses. By diversifying, investors reduce their exposure to the risks associated with any single asset. This approach helps protect the overall portfolio from significant downturns in specific sectors or markets. Investors should remain informed about prevailing market conditions. Continuous monitoring of investment portfolios is essential. Preparedness to act swiftly in response to market changes is crucial. Adjusting investment strategies based on current market analysis is advisable. The financial system's vulnerability persists despite past crises. The lessons of Black Monday have not been fully integrated. This lack of learning leaves the system susceptible to future shocks. Greater accountability is needed from policymakers and regulators. Viewers are urged to demand systemic improvements to prevent future crises. The video concludes by prompting viewers to subscribe to the channel. The call to action encourages continued learning in finance and economics. Subscribing provides access to more educational content on these subjects. Viewers are directed to additional resources for further study. The aim is to foster ongoing engagement with important financial and economic topics.